Hey, it's Eric Osnes with Homebridge Financial Home Mortgage with an update, my weekly update on mortgages and interest rates for the week ending June 10th, 2022. Well, the CPI numbers came in hot for the month of May, up 1% for the month for a year over year rate of 8.6%. This was the highest reading since that band Journey was belting out Who's Crying Now back in 1981, back when I had hair. Looking at the breakout of the CPA, there's some interesting numbers in here. One of them is the rent index, which showed increases right around 5.2%. I think that's lagging. That's a little lower than it really is, as well as housing lagging at about 5.1%, food up 10% year over year, new cars up 12.6%, used cars up 16.1%. All of these, of course, are signs of inflation. The numbers will probably get a little bit worse before they get better. The bond market did not like those CPI numbers at all, obviously. They also didn't like the ECB, the European Central Bank, plans to increase their benchmark rate from a negative zero point 0.5 to about zero, ending the Europeans' experiment with loose money and the resulting inflation. For the week, mortgage rates were higher. Here's the national averages: 30-year fixed rate conventional loan, 5.85%. That's up 0.45, almost a half a percent from a week ago. 15-year fixed rates, 5.12%, up about 0.34% from last week. FHA and VA 30-year fixed rates, 5.5%, up a half a percent. Jumbo 30-year fixed rates, 4.95%, up about a third of a percent from last week. And 5/1 ARMs, 4.95%, also up about a third of a percent from last week. Rates are still trending higher. We're going to be dealing with that for a little bit additional time here before we do see things possibly, hopefully, slow down just a little bit. In other news, the experts have chimed in on the prospects of a housing bubble. Let's not correlate interest rates to house prices. Will these higher rates lead to a bubble? Well, the internet is always full of doomsday predictions that a bubble is imminent. This could be a sign of what psychologists call recency bias. That's the psychological phenomenon where you give more importance to more recent events rather than taking in the bigger picture. It's important to know that the housing market has experienced a crash only one time in the last 70 years. Many of us remember that one acutely from 2008 to 2009. But did you know the markets only took about 4 years to recover? That means we've had only 4 down years out of the last 70. Just last week, Zillow interviewed more than 100 economists and experts from academia, government, and the private sector. 60% believe that the nation's housing market was not in a bubble. And really just explained by fundamentals such as demographics, shifting in housing preference, and most important, scarce inventory. Just simply demand exceeds the supply. 60% is not too bad percentage for economists. They say if you lined up all the economists in the world, they'd never reach a conclusion. And there's always been a crash bias narrative in the media. Here's just a few that we've seen over the past decade. 2012, shadow inventory will cause prices to fall. Shadow inventory, in reality, that was distressed homes that were caused by the big housing crisis, was less than 6 months, and it did not result in a bubble. 2013, housing will crash because the Fed is tapering and mortgage rates are rising. In reality, the 10-year yield did shoot up from about 1.6% to 3% back in 2013. We called it the taper tantrum. Cooling housing noticeably, yeah, but there were no negative price declines and inventory levels were relatively low at about 5 months. 2014, housing will crash because purchase applications are down 20%. In reality, even though sales activity fell and inventory grew, house prices did not decline. Inventory remained pretty close to 6 months. 2015, boomers turning 62 will start a tsunami of downsizing that will collapse prices because nobody could afford to buy these homes. In reality, that silver tsunami never materialized. 2016, manufacturing was in a recession and stocks were down 15%, leading to a crash. In reality, home prices grew because inventory fell. Again, supply and demand. 2017, because house prices were back to housing bubble peak, prices had to crash. In reality, inventory fell again and house prices rose. 2018, with mortgage rates rising to 5% and new home sales sector getting hit, housing would crash. In reality, sales fell, but total inventory did not grow. No crash. 2019, housing would crash because inventory was up year over year. In reality, as rates fell, housing rebounded in the second half of 2019. No crash. 2020, COVID-19 hit and the economy stalled. A crash is imminent. In reality, we saw a K-shaped recovery and witnessed the greatest housing recovery we've ever seen. 2021, forbearances from COVID-19 will result in mass foreclosures, causing a housing crash. In reality, we experienced one of the lowest foreclosure rates in history. 2022, what we're seeing right now, rising rates will cause housing to crash. In reality, there really is no correlation between rates and a housing crash. Housing prices are a factor of supply and demand. Rates are cyclical, meaning the refinance to a better rate is almost always around the corner. If you're in that sort of wait for the bubble camp, I hope this sort of short walk down memory lane will give you some perspective to just how unreliable some of these headlines can be. I'm always here and available to answer questions, run numbers, help solve those story problems. You can reach me anytime, Eric at ericismybanker.com. Call me 206-915-ERIC, 915-3742. Listen to my weekly updates like this. You can search me on social media. Just look for Eric is my banker, or listen to my weekly radio show on AM 1590 at Saturdays at 2 and Sundays at 3. Hope this information is helpful. Have a great week. Talk to you next week.